Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect the premium upfront, and generate a consistent return year on year. And we're also going to take a look at how you can manage those positions once you've got them on, and we're going to use some real life examples in our live portfolio. This is our small portfolio, but we're still going to take a look at some examples. So the first thing we want to do, of course, we're going to be using options as our vehicle to generate these returns. Specifically, we're going to be writing or selling these options contracts, not buying them. So we need to see where we are in the options cycle. So if we pull up the options chain just for any underlying, we can see where we are in the cycle. So we've got our expirations here on the left, September 20th being the closest. Then we have our weeklies, and then we have our next monthly, which is October 18th, some more weeklies, and then some more monthlies. So we want to stick with the monthlies. And so the next monthly is September 20th. It's 2 days away. It's far too close. So we're going to go with October 18th, which is 30 days away. Now, at this point, it is kind of getting a bit close. You want to be somewhere between about 30 and 60 days out. So this is on the lower end. You could go with the November 15th expiration, and that wouldn't be wrong of you to do that per se. This is more of a personal choice. So we're just going to stick with the October 18th for now. And so now we know that our contract is going to last 30 days roughly. So we pull up our watch list and we want to filter out any underlyings that have earnings over the next 30 days, right? We do not want earnings to disturb our trade and start causing problems. So once we've got our watch list up, everything here does not have earnings over the next month. What we want to do is list everything, order everything from high IVR to low IVR, right? And the reason for this is we want to sell volatility and we want to play the contraction, okay? When we are looking for things to trade, we want to keep in mind what our current portfolio looks like. If we are too heavy on one specific sector, then we don't want to be looking for new positions in that same sector. For example, if we've got a ton of airline companies, we don't want to then look for another airline company. We've got SMH and AMD and Intel. We don't want to look for Nvidia. We want to look for something else, right? So we just go down our watch list, and we want to be trading things that have an IV rank of over 50. Over 30 is okay too, but generally speaking, over 50 is ideal. So let's have a look at EWW. It is an ETF. ETFs typically have less volatility compared to companies. However, your P&L will likely be much smoother with an ETF because they move less erratically. So with EWW, you trade it the same way as with anything else. Obviously, we want to go to the October 18th expiration, and now we're looking at the options chain. So we want to have a look at the spread first of all. As we can see here, $1.75, $1.90, $1.25, $1.40. Our spread, as you can see, is anywhere from 10 to 20 cents wide, which is definitely not the best. However, it's not too bad. We can definitely still take a look at EWW, see if we can find a position. So we look at the delta column, and we want to be around the 16 to 20 delta mark. So on the call side, we're going to go with the 20 delta, and then on the put side, we can go with the 17 delta. That's going to land us at the 51 and 59 strikes. So we'd be selling or writing the 59 strike contract and also writing the 51 strike contract, okay? In doing this, we would collect 90 cents of premium up front. That's 90 cents times 100 shares. So that'd be $90 in premium up front. And it would require $700 in buying power to be tied up in order to open this trade. We would have a 67% probability of profit, and there's an 87% chance of hitting 50% of max profit at some point over the next month. So this is a very, very high probability trade. This orange bar here is the expected move of the underlying over the next 30 days. And as we can see, we'd be looking to sell our contracts further out beyond the orange bar, and that's reflected in our very high probability of profit. So if we just plot this on the chart, 51 and 59 strikes, let's see what that would look like. So 51 would put us there, and it was the 59 strike, and that would put us right about there. So as you can see, we are smack bang in the middle of the range. I personally don't trade off of support and resistance. However, if you do, there's probably something of meaning here for you. And it's not that long of a trade. It's only 30 days, and we'd probably be looking to get out of this position in a week to 2 weeks, something like that, maybe even less. And generally speaking, that's how you can find positions to add to your portfolio. If this position was a bit too large for you, by all means, you could just buy a contract a little bit further out on both sides, and that's going to limit your loss. It's going to reduce your premium that you collect. It's going to reduce your probability of profit, but it will also reduce the amount of buying power required. And as you can see, that will create a much higher return on capital trade for you. So whether you've got a small account or a large account, it doesn't matter. You can always manipulate the positions to fit. There was one thing that I wanted to go over with yourselves, and it was UAL. We have been managing UAL pretty heavily recently. As you can see here, these are all the rolls that we've made. We started off with an original strangle. We rolled the put side up from the 35 to the 42 strike. Then we rolled the 42 strike into the 48 strike. And then we rolled the 48 strike to the 50 strike. And at that point, this position was a straddle. Both the call and the put was at the 50 strike, and then the market kept moving against us even higher. So then we turned the straddle into an inverted strangle, and we rolled the put side up above our call strike up to 52.5, and we've collected a very nice big premium of $3.74 so far on the position in total. So if we have a look at what that looks like, our naked put is here at the top. Obviously, it is above our call, hence why it is inverted. So if we want to calculate our break-even points, so we've collected a total of $3.74 on this position. Our inverted put contract is at $52.50. So we add $52.50 to the total amount of premium that we collected, which is $3.74. So that comes out to 56.24. So our break even on the top side is 56.24, which is about there, right? Which puts us right at the top of this little range. Now, the reason why our break even is so wide is because we've been collecting a premium. Every time we roll, we've been getting paid to roll, which is constantly pushing our break-even points out. Because we are inverted, we've locked in a loss essentially of $2.50. But we do have a total collected. We've collected a total of $3.74. So we're playing for $1.24 of profit at the moment, right? That's assuming we don't collect any more credits. So we're going to look to see if the market can just cool off a little bit, if things can kind of just move down maybe a little bit, volatility can move down, and then hopefully we can look to exit this position with a respectable amount of profit. It'd be nice if we could take $1 out of the market. And this is the reality of what managing positions looks like. Okay, so this ordinarily probably would have been a losing position. However, we've been rolling. We've not actually had to roll out in time. We've just been rolling in the same cycle. We've collected more premium. We've reduced risk. We've rebalanced our deltas. We've given ourselves another opportunity to be right. And that's what this game looks like if you want to be in it long term. When everything is going easy, it's easy. But when it's not going to plan, that's when we have to earn our money. And that's what separates us from everybody else. So with that being said, we're not going to go through all the positions. We probably will take a look at taking off Intel at some point soon. We're looking, we're at 26% profit. Um, and that's basically it. So with positions, you want to make sure your position sizing is on point and correct. We do have a position sizing template that's free for everyone to use. The way it works is you enter in the size of your portfolio. Let's say if it's $14,500, you then below that enter in what the current VIX level is. Let's say if it's at 12.1. Everything below will then be calculated for you. All you need to do is use this to form the backbone of your portfolio, use it as a guideline, and long term, you will be just fine. You can get yourself a copy of this. Click the link in the description. It's completely free. You can click on this free position sizing template. If you want access to all of our positions, you want to make money with us, see what we're doing in our portfolios, by all means, link in the description. Click on EDS Premium. Get yourself signed up. It'll give you access to all of our portfolios so you can copy all of our positions. There is a full course, so no prior knowledge is required. We'll teach you everything you need to know. It allows you to learn and earn at the same time. It is a private community, so you can speak with myself and other like-minded individuals. There is a 100% money back guarantee. So if you've gone through everything in the course, followed our trades for 6 months, and you haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's risk-free on your part, and it's £1 a month. The price will be increasing. However, whatever price you get in at, you're locked in at that price. You will not be affected by any future price increases. You are rewarded for getting in early. So, with that being said, I will see you guys on the inside.